So you added a ton of value to one of your properties, but now you're going to go sell it and you're looking at a huge tax bill. What can you really do to get away from that? Today I'm going to be going over just that with 1031 exchanges. So stay tuned. Hi, I'm Emmanuel. Welcome to If I Can, You Can, the channel where if I can do it, you can do it too. To go with real estate investing and home renovations. As always, if you like this content, please like and subscribe below. Leave me a comment. I always want to hear what you have to say. But today we're going to go over 1031 exchanges and how they can affect you with your real estate investing. First, let's go over when you should use a 1031 exchange. Now, in a normal trade, what you'll do is you'll have a house, add in some improvements, get some appreciation, and you want to sell and get a little bit of that profit. So let's say you have a house and you bought it for $50,000, put another $50,000 into it, and all in your $100,000, and now it's worth $200,000. That extra $100,000 on profit you're going to get taxed on, and depending on how much you're making and how you set up your tax structure, that could be a huge chunk of it, 30+%. However, what you can do is use a 1031 exchange where you say, I'm going to go buy another piece of property with this, and I want to defer the taxes. Doesn't eliminate them, just means you're putting them off till later. So what that does, instead of taking that huge bite of 30% of $100,000, possibly $30,000 or more, what it does is defers it and lets you reinvest it and grow your business. It's an incentive to grow your business. So then later down the road, you get more and more, and the tax man comes at the very end when you ultimately sell your final property, if you get to that point. And that's what it's meant for, is deferring taxes. Now, how does this work out? You need to use a like-kind property to buy. So it could be a single family to multifamily. Almost anything works here as long as it's like-kind to what you're buying. And you got to talk to your tax professional. They'll advise you exactly what like-kind is and on some of the finer points on this. But let's say you're doing something like an upgrade. This would be the perfect opportunity for a 1031 exchange. You're moving from a single family home to a multifamily unit that you're trying to buy. So you take that same example I gave you, $100,000 in profit, and use it as a down payment to buy the other property. Great, you don't have to pay taxes, so you don't have a reduction in what your purchasing power can buy with the profits off the other one. You're growing your business. It's a perfect example. Now, there are some caveats to this. For example, there's a 45-day limit to identify the properties. So you got to get all your properties that you could potentially buy identified in that 45-day window, and talking with some people that are QIs, which are the qualified intermediaries, they will help you identify it, and they're going to probably charge you for every one that you identify. And after that, there's a 180-day limit to you need to buy the property before 180 days. Or guess what? You're going to have to pay the taxes. So the first of what you already were doing, there's not really a huge meltdown here if you mess this up. What ends up happening is you use a QI, your qualified intermediary, you pay some fees here and there for putting on some potential properties, and if that worst case scenario, none of the things go through, all you really did is pay the fees and you pay the taxes that you were already gonna pay. There's not a whole lot that can go super duper wrong where you lose all your money on this. So when should you use this? Like I said, when you're upgrading your properties, when you're trying to shift from a low yield to a high cash flow market, or heck, let's say you're diversifying your portfolio or you're consolidating your portfolio. You want to take a bunch of units and put it all together and buy one giant apartment complex so you're not spread out all over the place. Perfect opportunities to do this. Now, there are some other caveats to this, like the 3 property rule, the 200% rule, and I'm not going to go into those right now because that's something you really need to talk to your tax professional on, but they can go into nuances. If you want to hear about it, leave me a message. I'll look more into it. Maybe I can bring on a CPA and talk to you more about it too. But beyond that, there are some cautions you have to be careful of. Primarily, you got to make sure you're using qualified intermediary. The money cannot go to you at all in this transaction. You can't say, I'm going to sell it, I'm going to hold on to the money, give it to this person who's my QI, and then he's going to buy the property with it. Can't do that. You just violated the whole rule. The money has to go straight from the seller to your QI to purchase a property. Other ones, a 45 and 80-day rule, where you got to identify in 45 days, purchase in 180. Other ones are going to be reinvesting all the proceeds. You can't take out a portion of it. It has to all go to the next property. And finally, there's a lot of paperwork that goes with it, and it's pretty complex. So you're gonna wanna bring in someone who knows the tax structure on it. And there are a lot of gotchas on here. I know I was trying to do a 1031 exchange on one of my properties, and turned out it got me just in the nick of time where I had changed from my personal holding on it and putting it into an LLC. But you can't just hold it in the LLC for 2 weeks and then try to 1031 exchange. Whatever tax provision that violates, it's a no-go. So there's some nuances to this that you really need to talk to your tax professional on. Beyond that, just make sure you use a reputable QI and start doing your plans before you list the properties too. That's all I have for right now. If you have any other questions, please let me know. I'd love to hear them, but I'll see you in the next one.